Welcome to the deep dive. Today, we're jumping into Juniper Hotels Limited, specifically their financials and, well, some pretty aggressive future plans.
Yeah, we've got the details on their Q2 FY26 performance.
Right. So our mission is to figure out, what's behind their recent profit turnaround, how solid their operations really are, especially with room rates, and if this ambitious expansion blueprint can actually work.
It's a really interesting snapshot because Q2, July to September, that's monsoon season. It's typically slow for Indian hotels.
Mm-hmm.
So when a company posts strong numbers then, it's just something deeper is going on. Real resilience maybe, not just seasonal ups and downs. It really tests their strategy.
Okay, let's start with the money then. Segment 1. That Q2 financial bounce back. They hit their highest ever Q2 total income, 235 crores. That's up 5% year over year.
Decent top-line growth for a slow quarter.
But the big headline, I think, is the profit swing. They went from a 27.8 crore loss last year, Q2 FY25, to a positive consolidated profit after tax of 16.8 crores this quarter.
That is a powerful swing. It shows the leverage they have in the existing business. But, what's maybe even more important strategically is the margin improvement. Huge jump there.
How big?
Adjusted EBITDA, up 28% year over year, hit 82.6 crores. And the adjusted EBITDA margin expanded by 600 basis points. 600. Reached 36%.
Wow, 600 basis points. So is that just managing revenue better, or did they cut costs somewhere significant?
It seems mostly structural cost savings. They specifically mentioned optimizing HLP costs. That's heat, light, and power.
Energy costs.
Exactly. And here's the interesting part. They pushed their green energy usage way up, from 25% to 29% of total consumption.
So that's not a one-off trick. That's a real operational shift.
Precisely. It links their sustainability efforts directly to better margins. It's baked in now, you could say.
That's fascinating. Does that strategy hold up long-term, though? I mean, betting on land appreciation and hotel revenue. And could green energy costs spike and eat that margin gain later?
Well, there are always risks with commodity prices, of course. But shifting towards green energy often reduces reliance on, volatile fossil fuels.
Yeah.
So it could be a net positive long term.
Right.
And for now, it definitely helps their balance sheet look strong. Their net bank debt to EBITDA is only 1.4x. That's very healthy.
Gives them headroom for debt, you mean?
Significant debt headroom, yeah. Their borrowing cost is about 8.3%, and they're earning nearly that, 7.9%, on their invested deposits. So financially, they seem well positioned for the expansion push.
That debt capacity is crucial, especially as we get into segment 2, the operational drivers.
Exactly. Because even though Q2 is usually soft, the underlying demand across the whole sector looks, well, pretty strong.
Still, despite the monsoon.
Yeah. Domestic travel is holding up, corporate travel is picking up steam, and they're seeing healthy forward bookings for the upcoming festive and wedding seasons.
And it's not just more people, it's better quality stays. We saw that Global Business Travel Association finding about leisure.
Ah, yes, leisure. Business travelers extending trips for leisure.
Right. And apparently they're willing to pay for premium experiences. That seems to fit right into Juniper's luxury focus.
It absolutely does. And that's why their focus on average room rate, the ARR, is so important. Consolidated ARR grew 7% year over year, reached 10,599.
So they're prioritizing higher rates over just filling rooms cheap.
That's the strategy. And you can see it working in specific hotels. Take Grand Hyatt Mumbai, GHM. Its ARR grew 6%.
Okay, solid.
But here's the kicker. Its local competitors, their ARR actually declined by 2% in the same period.
Whoa. So GHM significantly outperformed its direct competition.
Massively. And then there's Hyatt Regency Ahmedabad, HRA, that was the star, 17% ARR growth, 17%. Its competitors only managed 6%.
What drove that in Ahmedabad?
They mentioned getting good traction in the contract segment there. But overall, this outperformance, it's down to a deliberate operational shift.
Okay, so what is that core strategy driving this rate resilience?
It's really about closing the ARR gap with competitors. At GHM, for instance, they actively changed the mix of guests, moved away from some of the traditional lower-rate business, think contract deals, airline crews, that sort of thing. And they focus more on higher-paying transient guests and group business.
Optimizing the guest portfolio for higher yields.
Exactly. That portfolio mix shift is key to the outperformance. And, having success with that high AR strategy must give them a lot of confidence for planning new hotels, especially in, let's say, less tested markets.
Yeah, that makes sense. Which leads us nicely into segment 3, the aggressive blueprint. Juniper's future plans seem focused on, well, big hotels in major cities, like that huge 508-key project in Bengaluru. Phase 1 is due Q1 FY27, right?
Correct. Phase 1 is 235 keys, then Phase 2 adds another 273. Site work for Phase 2 should also start around Q1 FY27. It's a massive asset.
But the really big strategic pivot seems to be geographic. They're pushing hard into new areas.
They are. Let's unpack the Northeast focus. They actually broke ground back in September 2025 for a luxury resort in Kaziranga, Assam.
Kaziranga, known for the rhinos, right?
Yep.
Ecotourism hotspot.
Precisely. It'll have 111 keys, a mix of rooms and villas, aimed squarely at domestic and international ecotourists.
And the rate expectations there are pretty eye-watering.
They are projecting an average room rate over 30,000 DL. That's a huge bet on luxury ecotourism taking off there.
30,000 rupees a night. Wow. And they're also planning something in Guwahati.
Yes, finalized design for a 340-key property in Guwahati. That one's mixed-use, 250 hotel rooms plus 90 apartments.
Okay, so why the big Northeast push? What's the context?
It ties directly into massive government infrastructure spending in the region. We're talking nearly 45,000 crore rupees sanctioned. That's 44,859 crores.
Huge numbers. What kind of infrastructure?
Over 5,000 kilometers of road projects are underway. Think about that 5,000 kilometers. Plus, 10 new greenfield airports have been built there in the last 11 years. It's fundamentally changing connectivity.
So Juniper's strategy is basically get in early.
Be the first one in each market, as they put it. Capture that initial growth wave spurred by the new infrastructure. First mover advantage.
Requires a lot of capital, though. What's the bigger picture, the long-term target?
Extremely ambitious. They want to grow from about 1,900 keys now to over 4,091 keys, specifically by FY29. That's more than double.
How do they decide where to put the money? Are there specific return targets?
Yeah, they have a hurdle rate. They're aiming for mid to high teens return on capital. Yeah. And critically, they're picking locations where they think the land value itself could double in 5 years.
So it's a twin bet. Hotel profits and real estate appreciation.
Exactly. It's a layered strategy.
Right. Speaking of ambition, let's move to segment 4, future bids and strategic challenges. They're looking even further afield now. Bids submitted for the Andaman and Nicobar Islands.
That's right. Greenfield projects in Port Blair and Neil Island. Pure leisure and ecotourism plays.
Interesting. Do they have a benchmark for what might be possible there?
They do. They noted that the Taj property on nearby Havelock Island is already doing around 30,000 ARR, so that shows a potential for luxury rates in that area.
Okay. And they're also targeting the MICE segment heavily.
Very much so. Well, let's clarify MEC for listeners who might not know the term.
Good idea.
MCE stands for Meetings, Incentives, Conventions, and Exhibitions. Basically, large corporate groups, conferences, big events, usually very high-yield business for hotels.
Got it. So where are they targeting MCE?
They put in a bid for Yashapumi in New Delhi. That's near the airport, a major new MCE center. They're also planning to bid for DDL Eastland in Dwarka, Delhi, another big convention center project.
Okay, so externally, it's full speed ahead. But internally, Q2 wasn't entirely smooth sailing, right? There were some exceptional items, some cleanup.
Yes, a few things to note. That Bengaluru construction project had a fire back in April 2025.
Right, I remember that. How did that impact Q2?
They booked an initial net loss of 17.14 crores for it. But they have submitted an insurance claim and already got an interim payment, so they're managing the financial impact.
Okay, what else?
They also settled some old litigation, a vendor dispute dating back to 2013. They took a 3.78 crore exceptional loss to settle it amicably. Seems like cleaning up historical baggage.
Right, clearing the decks. Now, what about the finance costs? There was a hit related to foreign currency borrowings.
Yeah, a 7.5 crore hit in Q2 finance costs. It's linked to their $35 million external commercial borrowings, or ECBs. It's a notional provision.
Notional, meaning not actual cash paid out.
Correct. It's an accounting adjustment reflecting the potential impact of the rupee weakening against the US dollar on that outstanding dollar loan. Basically, recognizing the currency risk on paper based on the exchange rate at the end of the quarter.
Are they doing anything to manage that risk going forward?
Yes, they mentioned they're looking into a rolling hedging strategy that would help protect them against future currency swings on those ECBs.
Okay, makes sense. Finally, the ROFO assets, the integration of properties from the promoter family. What exactly is ROFO and why is that process delayed?
ROFO just means right of first offer. It gives Juniper the first chance to buy certain hotels owned by the promoter family, like the refurbished Hyatt Regency Mumbai.
So why the delay in bringing those in?
It's not about lack of money or willingness, apparently. It's just complex.
Hmm.
Integrating assets across three different listed companies involves a mountain of regulatory paperwork, compliance checks, valuation processes, shareholder approvals. It just takes a long time.
Management says this delay won't stop their overall growth plans.
Correct. They seem confident they can hit their targets, mainly through the greenfield projects we talked about, the new builds. That's a clearer, less complex path to adding keys right now.
Okay, so let's try and synthesize this for you, the listener. Juniper Hotels Q2 wasn't just about surviving the monsoon slump. It really showed off a strategy focused on efficiency and high room rates.
Yeah, they demonstrated real operational strength, expanding margins through things like green energy. That's a structural plus.
And that operational success, that financial strength, it's basically funding this very calculated, very aggressive expansion plan.
Absolutely. They're using that strength to be the first mover in these newly opening markets, like the Northeast, and targeting high-value segments like MIC and luxury ecotourism. And remember that bet on land appreciation, too.
So what does this all mean? Maybe the future for high-end hotels in India isn't just about fighting it out in the big metros anymore. It might be more about finding and quickly capturing these brand new pockets of demand opened up by infrastructure investment, places with huge ARR potential.
Which leaves us with a final thought for you to chew on. We know the government's pouring almost 45,000 crores into infrastructure in places like the Northeast. How fast will demand catch up with, or even outstrip, supply in these new hotel markets? And could this fundamentally shift where high-end tourism happens in India over, say, the next 5 years?
Something to think about. We'll see you next time on The Deep Dive.